Start recording. Hello, welcome, good afternoon, everyone. Thank you so much for joining us today. I am Sam Story. I'm the Senior Director of Economic Development at the Downtown Partnership of Baltimore. For many of you, this is your third time this week seeing my face. So thank you so much for sticking with us and attending all of these workshops. Today, I am really happy to have with us Danielle Dahrouj, who is a business advisor at Baltimore Community Lending, David Freeman, who's also a business advisor at Baltimore Community Lending, and then Ulric Donawa, who is a loan officer. So today at Baltimore Community Lending as well. So today we are going to be having a presentation on compiling your financials. So this is one of the few requirements that we have for the Downtown Boost program, is submitting a full year's worth of financials. And so what does that mean? These folks are gonna be going through that with you. And so all of the things that we will be discussing today will be recorded, put on YouTube, and then distributed to you guys afterwards. I'm about to put in the chat, I'm gonna put in the chat the handouts that these guys are going to be discussing, as well as their presentation as well. So right when they get going, I'm going to be distributing it. You'll notice that I have figured out through the magic of technology how to activate the chat. I know that was something that I couldn't figure out earlier this week. So please feel free to put all your questions or comments or anything into the chat window, and we will make sure that they are addressed during the presentation. So Danielle, David, I don't know who is going to be taking it from here, but please, thank you for coming, and we're happy to have you.
Thank you so much, David. Go ahead.
Good afternoon, everyone. I appreciate you having me. Look forward to going through this information with you. Feel free to put any of your questions in the chat. At the end of each section here, I will give you the opportunity to ask me questions. I just want to make sure, are you able to see my screen right now?
Yes.
Okay. All right, so today we're going to discuss the three most important financial documents that you need. So as far as processing loans, anytime you go to a bank or anything like that, you want to be able to have this information readily available. I know it's a little bit difficult sometimes, a little overwhelming trying to gather those and put that information together. Let me just hold for 1 second here. I have a little bit of technical difficulty. Give me one moment.
And just while you're figuring that out, David, I just wanted to make sure everyone knows I have shared all the presentation that folks are going to be going through, as well as the samples for the profit and loss, the cash flow, and the balance sheet. So that should be in everyone's chat. Please take a look and let me know if you have any trouble accessing.
What's my PowerPoint is locking up with me here.
David, would you like me to pull it up and I could go through, or?
Let me do one thing. Let me stop sharing for a second for this video.
I'm going to try one more time on these links. Do you folks still don't see them in the chat? It says that it's sending. Okay, I'm going to email it out then. Sorry about that, everyone.
My screen is showing up as blank or black. Even this is Ulric, even though I have my video on. So I'm not sure why that is.
Give me 1 sec. My PowerPoint crashed on me. I'm rebooting. Give me 1 sec.
Hey, David, no problem. I'm just going to pull up the presentation and I'll share my screen. And then when you are ready to change slides, just tell me to change slide, okay?
While everybody's taking care of the technical stuff, do you like to introduce some of the folks on the webinar to see what kind of at least work line are they in and so forth and so on, so we get to know them?
They're all mainstream business in downtown Baltimore.
I was just thinking.
Yeah, so folks, why don't you please put your business and you know, your name and business in the chat box and and introduce yourself to the group, please. Thank you.
That's great.
All right, here we go. I'm going to share my screen and we are going to get going now.
Okay. Wonderful. I see some of the chats coming through. Wonderful.
Okay, David, are we ready to get going?
That's beautiful. Oh, that is great.
So I can do a brief overview while David is getting ready. Can you all hear me okay?
Yes.
Yeah, okay. So with Baltimore Community Lending, we do comprehensive business coaching related to several aspects of a small business's preparation for financing and business growth. And it all revolves around financials. So to that end, we need the business owner, whatever stage they're in when they come to us, to be conversant, to be familiar with basic business financials, which include the profit and loss statement, the balance sheet, and the cash flow statement. The profit and loss statement is sometimes referred to as the income statement. It's exactly the same thing. So wherever a business owner is when they come to us, at the point that they're ready for financing, they should have some familiarity in varying degrees, depending on the type of business they have, with what these statements are, because they will be able to read and discuss to some degree these three key statements in managing whatever type of business they're in. So that's essentially what we're going to talk about today: what these statements are, why they're important, and how to work either with your accounting software or with your accountant to ensure that you have these prepared properly and able to use these reports to manage and grow your business effectively. So with that said, David, are you ready to roll on the first slide?
Not yet, I don't think.
Daniel, are you able to?
Absolutely.
Yeah.
I don't have the power presentation. He is the presenter, so he does have it. Yet I will be more than happy to start as well with what we're trying to do here. I was able to read each and every chat that you put in there. Pleasure to meet you all, guys. It is amazing what you're doing for Baltimore, and it is a pleasure for us to be part of this. Now, this is the situation. We are all good at what we do, right? It's either we do design or we do retail stuff, or we do cloth design. I saw in here as well, like some kind of museums. That is great. So the thing is, though, not all of us know how to put together a P&L, which is profit and loss, right? So we are good at what we do, but this part is the face that we have in front of every bank. This is the face that can tell everybody, look what we're doing, for us to look credible in their eyes, and for us to show sometimes that we do have some skin in the game in order for them to give us either more money or to trust us with some retail space or to do what they need to do, whatever you need to do, right? Your next step in business. So the P&L is whatever you profit, is gonna go registered in there, and whatever your loss is gonna be coming out. So it's like a checkbook in the old days. Do you guys remember it? I don't know. There's some young folks in here, I noticed, but it comes, some stuff comes in, some stuff leaves out. And then there's several ways. Don't be stuck on like, what kind of software do you want to use? There's a lot of ways that you can log this in and out.
Okay,
Okay.
looks like David is back with us. David,
David
you
is
on?
Sorry about that. Yes, my PowerPoint crashed on me, so apologize.
Okay,
Anyway, thank you for filling in, Danielle.
No problem.
So I'll jump right in. We know there can be a little bit of a challenge to gather this information, a little bit intimidating. So one of the things we want to try to do is simplify that process for you, make it as easy as possible. I think Danielle mentioned there's a number of software products that can kind of assist you with that. We'll get into that a little bit later. Profit and loss, understanding your profit and loss. The P&L statement. I mean, basically, the best way to look at this is your revenue minus your expenses. You have a number of expenses that you go through throughout the month. So one of the things you want to do is take your revenue minus those expenses will give you your net, which will end up with that profit. It's not a checking account balance. It's not good for indication of how your profit of business is made or amount available for owner's draw. Whether you make a profit, you will have an incur the loss, and the basic formula for P&L statement is, just to give you an idea, so sales minus cost of goods equals your gross profit. Gross profit and operating fixed expenses equals your net profit.
so just to flesh that out a little bit there, that was a great overview that Dave gave. Sometimes if you have a business that has equipment and you're depreciating the equipment, that's a huge piece that you don't want to miss, and you don't want your accountant to miss, because let's say, for example, you have equipment. Let's say you're a restaurant, you have equipment. That equipment is depreciated, which simply means that the useful life of the equipment, let's say it's 5 years, you take a portion of that cost of the equipment and deduct it over 5 years. Let's say you paid $100,000, so you deduct $20,000 a year as equipment is being used up, and that's an expense on your P&L or profit and loss statement. But you didn't write a check for that expense, right? So even though it's an expense, a lender like ourselves can add that expense back into your revenue because you didn't actually spend that. But the IRS, the accounting rules, allow you to deduct that depreciated expense. So you want to make sure that you have an accountant or accounting software that takes into consideration that very important factor, depreciating any equipment that you have.
I would definitely recommend consulting a tax advisor when it comes to that depreciation. Moving on with the profit and loss, just want to review some terms. We'll talk about that revenue and then your expenses. We'll talk about your sales, your income, your revenue, the total amount of selling your products or service during that certain time period. Then again, minus those cost of goods sold. Cost of goods is a variable cost. Costs you incur during direct producing or selling your production or your service. Gives you that gross profit. Gives you your gross profit. So with that, we'll continue on with your operating expenses. So give a couple examples of operating expenses. I think we have a lot of retail on here. So the number one, the largest expense when it comes to operating expenses will be what? Your human resources. So we're talking about wages. That would probably be the most expensive when you're paying your employees. any transportation, any of the products that you purchased, all your operating expenses. And then left will give you your net profit once you subtract those. Now, this is a high overview of a profit and loss. Keep in mind, there are some ratios that you can calculate to kind of benchmark where you are as compared to other businesses within your industry. So you want to keep that in mind. A lot of times you will run those ratios to determine where you are. Like, for example, marketing. So for marketing, it should not be any more than 3% of your revenue, just for example, as a benchmark. So we try to look at those couple of things once you get a little bit deeper in developing that. So before I move on, does anyone have any questions, any concerns? Can't hear you, Danielle.
I apologize, the police car just, I live in Baltimore City, and I just wanted to like cut off the noise. So basically what I was gonna say is there's a lot of folks in the chat that were asking questions. One of them said, can he pull it out of his taxes? May I answer that question by saying, this is what goes into your taxes. Now, if somebody else is asking for it, probably, yes, that's what went into your taxes. But originally, that's what you gave the tax advisor for him to go with your taxes. But what Ulric is saying, right? So what shows up on your taxes, a lot of times there's a lot of depreciation that you have the right to have. Sometimes any lender or any landlord or any folks who you're doing business with who ask for this stuff will probably add some figures if necessary for that. So that, I hope I answered your questions. If I didn't, kindly put it again, or just see what did I miss. There's another question talked about the software as well. What is the best software to use? The best software to use could be a simple Excel sheet in the beginning. I recommend that. If QuickBooks is too hard for you, QuickBooks is the best software out there, but if it's too hard to handle, just maybe you can get some help set it up, or you might get some help with an Excel spreadsheet, simple. Or if you are an iPhone person, numbers on the iPhone works perfect as well. All it is in and out.
I would just add to that. As far as with QuickBooks, it is pretty efficient and easy to use. They do have a number of YouTube trainings that you can kind of reference. Give you some training on that. As far as with the profit and loss, the big thing is what does it do? What does it mean for your business? So when you take a look at that, again, I mentioned those ratios, but when I look at it, what do I expect in my sales? What have I expected rather? Were they better or worse? Did I hit my goal? Did I reach my sales target? Did I miss my sales target? In either case, you want to address it. You need to reconsider what happened. So you want to look at this report and say, okay, what can I do differently to reach those sales goals?
Yeah, I noticed a question also in the chat about cost of goods sold, excuse me. So in the case where your business, let's say it's a restaurant, it's a business that has a product that you're converting into an end product, like, you know, raw food into a nice menu item. The cost of goods sold is deducted from revenue before all of your operating expenses. So there's a differentiation between your cost of goods sold and your operating expenses. So the operating expenses include all of the other things that you typically would expect to deduct, the cost of phone, the cost of your cutlery, the cost of all those other things are operating expenses. And then after deducting cost of goods sold and then all of the operating expenses, then you get net income, and the owner gets paid out of net income. hopefully it's a it's a profit, right? And so the owner doesn't deduct their draw from the expenses, particularly in businesses of this scale, where it's where it's an early stage business, and the owner is, it's a one or two person operation, and they're a sole proprietorship or an LLC, or sole member LLC. They will just take a draw because all of the net comes back to them. So hopefully that helps with the cost of goods and the idea of expensing.
May I add something here? It's amazing what Ulric said. So if you guys have hopefully a pen and paper in front of you, right? So if you write at the top of it is what came money this month, right? Then you minus from that your fixed costs. They call it fixed cost, right? Which is rent, telephone, internet, car lease if you have it, so forth and so on. So those are fixed, no matter if you sold $1 or if you sold $1,000 that month. Regardless, those are fixed. You can't play with those, right? So that's your fixed cost. Then you have something called variable cost. The person that I want to answer in the chat that said, where does it come from? So you sold, let's just say $1,000 that month of products, yet you bought $500 products. So that has to go in here. That's a variable. This month you bought 500. Next month you didn't want to shop that much. You shop for 200 or 300. You had enough inventory. So if it makes any sense, there are some stuff that are fixed cost and there are some stuff that are variable cost, right? And then as long as you have this mentality, you can group them together. Which ones are fixed? Which ones are variables? That helps you as well. I'm sorry, go ahead.
Thank you, Ulric, and thank you, Danielle. All right, so as we were talking about those fixed costs, variables, I think you mentioned already that your net profit would definitely come from your owner's draw will come out of the net profit, your income taxes, reinvestment in the business, and expansion for equipment. So we talked about if you don't hit your sales revenue, when you're looking at this, you're trying to figure out why. What things to consider. Are you reaching the correct customers? Were there unanticipated conditions that contributed to your sales not reaching projections? How will you be able to maintain or improve sales going forward? So these are the things that you want to kind of look at when you're reviewing that, and make those adjustments to your business. Remember, businesses are very fluid, meaning that it's changing from month to month, quarter to quarter, year to year. So you want to be ahead of the curve and always analyzing. So I think we talked about beginning and looking at this at least once a quarter. I recommend every month taking a look at it, but definitely once a quarter. And one of the things you want to prepare yourself to understand this report, meaning you already know that most accountants are pretty busy, so it's kind of hard for them to get that information back to you. So if you're able to actually review it yourself without your accountant, it'll make you a little bit more efficient in running your business and making those adjustments.
There is a question in here, David. Someone asked, may you make an appointment with any of us? Baltimore Community Lending is a nonprofit organization that is here for Baltimore. Anyone who needs help, we are here for them. So David and I are both technical assistants, i.e. business advisors. So we are here for you. Ulric is the big guns. Ulric is the guy that with the money, basically, when you guys want to get a loan to expand your business or start another growing, we call it growing loan. If you need any of that, Ulric is the man for that.
Just for clarification, I am one of the loan officers / underwriters, and there are three of us, myself, Ulric, Angela, and Don. So the three of us do the preparation for getting the loan ready for loan committee. So when you first come in, you go through our gatekeeper slash
Business coaching.
you go through
Our business coach.
Jacqueline, who collects some basic information and registers you. So that's your first point of contact. And then you will schedule time with Danielle or Dave to go through the business coaching process, and you will get on their calendars. And once they get through with their process and you're ready for the underwriting process, then they graduate you from our business coaching technical assistance program and refer you to one of the 3 underwriters, myself, Don, or Angela. So that's a basic overview of the process. So to make an appointment with us, we can send you the links to reach out to Jacqueline and to get on the technical assistance calendar. And that's how our process works. So we can share that with you towards the end of this webinar.
Absolutely. And then there's a chat in here that we need you all. Actually, we need you all. The businesses in Baltimore, what makes Baltimore great, and that's basically what we need. So it's we appreciate that. Go ahead, Dave.
Any other questions before I move on?
Yep.
Good.
Yes, your host at Downtown Partnership of Baltimore is the one who's going to pass you our information. No problem whatsoever. I am sure they have all your emails. I just want to mention that to you because just in case you're expecting specific one from us, I just want to tell you it's going to come from the Downtown Partnership of Baltimore. Go ahead.
I can put all the contact information as well as Jacqueline's contact information in the chat for everyone.
We appreciate
that right now. And then Quishana, I emailed out the presentations from yesterday. I emailed them out in the evening. So please check your email for that. All right, sorry to interrupt. Thank you.
All right, so the second report that is important to your business would be the balance sheet. The balance sheet shows you what you own, called assets, where you owe, called liabilities, and what's left over, the net value, will be the equity within your business. Your assets, it pays for borrowed money, which leaves your equity. The balance sheet numbers change time. You have the business transactions. Think of your balance sheet like a scale. Assets and liabilities alone are out of the balance until you add an equity. The last weight put on the scale makes it balanced. A business that manages its liabilities and builds equity over time is considered less risky by lenders. So real important. So it's called a balance sheet for a reason. One of the things is so that your total equity should balance with your assets. So whatever comes out on assets equals your liabilities. We kind of jumped into the depreciation on the P&L, but those all go into that. So liabilities, equity, your money, that balance sheet number changes, like I said, with every number. So when the assets, and I'm trying, Ulric, if you can help me out, give me a couple of examples. Let me work, I'll do it like this. So assets are done as liquidation, how you liquidate first. So cash would be number one. I'm going on to your assets. Cash would be the number one thing. Then receivables. So it's what liquidates the fastest. So cash, of course, you can spend that money right away. You have it. That's cash on hand. Inventory, you can sell, you can liquidate, you have that cash. So those would be your two. Liabilities are loans, any kind of accounts receivable, account payables that would go under that. And then, of course, the equity, which has been invested, we'll get a little bit further in that.
Mm-hmm.
All right, so on your balance sheet, you have current and non-current assets. They're divided into two categories. With the non-current, they're can be turned into cash quickly. So we kind of talked about that. Anything less than a year, and then non-current, it will be anything over a year fixture. So current example would be cash, accounts receivable, again, and inventory, cash, your money that you have in the bank, accounts receivables, cash that you own. Inventory products that you own will be turned into that cash. And then again, the non-current, according to how you liquidate quickly, they can be turned into cash. Non-current assets are furniture, fixtures, property, and equipment.
Okay, great. So now test time, right? For the person who is like doing let me go back and then see. For the person that is doing the service for the museum, right? So think about what is it that is non-current and then put it on the piece of paper. Think about what's current supposed to be, maybe, and I need to mention this because that's now the days, that's how people get paid too. Cash App, Zelle, all those monies that come in, just so you guys know too, that consult with a tax accountant, because this year we all have to report that. We all have to report anything that came to anything through electronically. So what I'm trying to say, all this, like Dave said, those are current assets. So make sure you put those in your current assets, okay? So think about everything that you own in the company. When this is done fresh in your mind, just do it today. Just put what comes in, how does it come in? Like David said, put them under categories, and then what is it not current? So I'm sorry to interrupt this, but I just really needed to mention the electronic payments as well, because everybody these days is getting paid that way. Go ahead.
Good point. Go ahead, Dave.
Go ahead.
Yeah, so quick point about the balance sheet. You know, a lot of times small business owners, fairly new in the process, think most about profits and revenue, and therefore focus heavily on the profit and loss or income statement, which is not a bad thing. However, lenders most often look to the balance sheet, which shows your assets. So what it means to a lender is, are you reinvesting in your company? Are you putting money into capital expenditures? Are you buying equipment? Are you keeping up with technology? Those items will show up on your balance sheet as assets. So it's important for lenders, whether Baltimore Community Lending or later on when you're working with banks and other lenders, that you understand the importance of the balance sheet, because they're going to look to see, you know, what are the assets of your company? How are you investing in your company, putting money back into the company, as opposed to taking it all out and spending it on personal items. So you want to think about realize that the company is a separate entity from yourself. Even though you may be the sole owner, you are not the company. So it has to have a life of its own, which means it has to have assets of its own. And it's good if over time it can be seen that the assets of the company is growing.
What Ulric said is so valuable, you guys. Please do not mix yourself with the company. Please do not mix your monies together. Try to have two separate accounts. Try to go to the bank and say, I would like to open a business account. There are a lot of banks that you can go to that they give you $100 to open a business account with them. Feel free to ask for that too. Additionally, what he is saying about separating yourself, when you separate yourself, please do not forget to pay yourself. Please do not forget to pay yourself, and make sure you list it as in a line that it's money to owner. Make sure you do that. I'm sorry, David, go ahead.
No problem. Once again, this report also has ratios, so you can kind of benchmark to your industry. Just offhand, a quick one would be your debt ratio. They actually calculate from this. So when the bank, when you already kind of brought up, when you're taking it to the bank, so your liabilities divided by your assets will give you a complete debt ratio. And then you can also do the current by current liabilities and current assets divided will also give you your current. So what those mean is how fast for every dollar can you return, make a payment on your liabilities and what they're actually looking for. So you look at the debt ratio, want to make sure that Ulric, can you let me know what would be, as far as from a banking, what would be a good debt ratio for businesses? I'm thinking 40%, but if you have something different.
In some of these early stage, but first there's a question in the chat about using business credit cards to help manage the categories of expenses.
Yes.
And that certainly is not a bad way, because many business cards today have categories where you can see what the expense categories are, so it's already broken down for you. But any method that allows you to see whether it's you manually creating an Excel spreadsheet, as Danielle suggested, or you using a software package like QuickBooks, or using your business credit card, whatever method works best for you, as long as it allows you to keep track fairly easily of the different categories of expenses, so you can see what's going up, what's staying steady, what contribution that category is making, or what percentage that is of your total revenue, so that you can manage your expenses better. Whatever works best for you is acceptable to most people or organizations that will analyze your financials. So that being said, so coming back to as far as the debt ratio, so in early stage companies, quite often your debt is going to be out of proportion to your revenue.
Absolutely.
And that's why a lot of early stage companies cannot get bank financing, because you simply do not meet the typical bank ratios of 40% debt to income, or the cash flow coverage ratios of 1.25 or 1.5 or better, which means that for every dollar of the expense, you have $1.25 or $1.50 of income. Or there are many ratios that traditional lenders use to analyze a business financing request, and if you don't meet them, then you're not ready. And so when you come to an organization like Baltimore Community Lending, a CDFI, a community development financial institution that understands the challenges that small businesses face and understand ways in order to help the business get financing anyway, while they grow with some assurance that they will be successful. That's the unique space that we fill. So we're not going by standard bank ratios. Otherwise, we will be no different than a bank. So some of the ratios that banks use will not necessarily apply with our organization.
That is a great point. And so every and each one of us at Baltimore Community Lending, we have a heart, and we are in the heart of Baltimore, so it's easy to reach us, right? And when a person says, I'm starting over, young lady, we all start over every day. So it's not a problem. It's never too late to fix whatever you've paid. Think about what you paid and everything like this, and then do it. It's never too late. Don't think, oh my God, it's not for me. The ratios, don't let those scare you. Start slow, get your business together, get enough coaching, and then this way you'll get bigger and bigger. Nobody started big. No one starts big. Additionally, big point I would like to make, and I would like to clarify, because I'm the one that came up with the Zelle story. So please know, when you pay via Zelle, that doesn't mean, yeah, of course you got to keep track of that, but you got to talk to your accountant to see up to what amount do you have to disclose to IRS that you paid this person, and you have to produce a 1099 when you pay college kids. And I saw that by Zelle. So the thing is, I pay college students by Zelle. Mr. Barnes, please, please, please consult with the tax accountant and then see what is the limit right now. Say to them, when do I have to produce a 1099 for the students? Because if that's the case, then when you hire those folks, you had to have them sign a piece of paper prior of doing the work for you. So be mindful of that as well, because this way you always want to be compliant with the taxes. Now, just so you know, everybody, just big point as well. What we do, your QuickBooks never looks like your taxes, because as Ulric said, your taxes will carry stuff that didn't really happen in real life. You got a depreciation for something you didn't pay that. You know what I'm saying? You paid it last year, but this year getting the depreciation on it. So sometimes there's a little discrepancy, you guys, just so you can be aware of it as well.
Thank you.
Oh, wonderful. Great. Mr. Barnes is saying he did send the 1099. Wonderful. But that's how you kept track of it through Zelle. Great job. That's great.
Another point about debt to income before we leave the balance sheet is that let's say your debt to income is 30%, right? So what that means is that 30% of the income, the cost of paying back the loan is 30% of the money coming in, right? So the lower that is, the better. But many times in small businesses, one owner or one or two owners, one or more of the owners may have outside income, right? So you may have a day job, right? And so as a CDFI, we take into consideration some of these other factors more heavily than traditional lenders would. So what I'm saying is, don't quit your day job until you're ready, right? And we absolutely will take into consideration that you have outside income sufficient to take care of your personal needs when we're analyzing your business debt to income ratio. So you don't have to necessarily figure all that out, but just understand, hold on to your day job, and then you bring us and give us all the information so we can figure out how best to position you to move forward.
Great point, Ulric. Any other questions, Danielle?
No, I just want to add, being a business owner takes guts. That's not for the weak. So you all here are strong folks. And what I'm trying to say by that is what Ulric said, like, keep your job. Yes, just a little bit to carry you over for you to do what you like to do. Because every business that you guys listening here is so impressive and so awesome. And I am sure you guys like to do it.
All right. Any other questions? Danielle? We're good. So we'll talk about equity as being that last part of it. This is known as your net worth once everything is taken into consideration. Is what shareholders own in your bottom line. This can be your profit that remains in the business. It could also be money that you've invested in the company. It is simply a figure as a total of assets minus your total liabilities. And just the balance sheet equation, and this is probably a little more detailed than you need, would be your assets equals liabilities plus equity. But with that said, the whole purpose of this is to give you that overview. So when I bring up the ratios, I don't want that to overwhelm you. I don't want that to be a deterrent. It's just letting you know that you can dig a little bit deeper, but we want you to have the basic understanding of the report.
I really like the point that David raised about net worth, net income. Lenders, Baltimore Community Lending included, look at your net income, net worth situation as part of their analysis. So your business is generating revenue, and if you have a net gain, you're in the black, as they say, right? That net income rolls to your balance sheet. So we can see that in the owner's equity portion of your balance sheet, that it's positive. And then you may draw on that, and that money now goes to your personal balance sheet, which we ask for. Is called a personal financial statement. So over time, now if you're fairly new in business, 3-6 months, a year, it may not be as significant, but let's say you've been in business for a few years. You're still a small business, you still have a lot of challenges, but you've been in business for a few years. So we should be able to see the asset accumulation either in the business or on your personal financial statement. So we're getting down into the weeds there to see, what do you do with your money, right? And if it just seems to disappear, we're going to make note of that. So understand that we ask for a lot of documents, we ask for a lot of forms to be filled out, and then we analyze those forms to make an informed decision about how you manage your money to determine how you're going to grow this business and pay the lender back. So we look at the balance sheet on the business side and the personal financial statement on the personal side.
Thank you, Ulric. And just to kind of tailor that back to something we talked about earlier, as far as commingling your funds, this part goes very important, is not to use the money in your business banking for any personal use. So that kind of lowers that final equity. So you want to make sure that you're not using that money to go to McDonald's or buy, hey, I'm going to use my business checking account to buy Burger King. You don't want to do that. No commingling your funds. You can't reiterate that enough. Before we move on, any other questions or comments?
May I add something here while you guys are thinking about questions or comments? Come on, you guys. All right. So basically, I want to say something about somebody says they would like to use their credit card itemized. This is a starting point, yet I just want to mention very, very, very slight thing that can make a big difference. When you go, let's just say, to CVS, right? You needed pens and pads, and you really needed them today to do whatever you need to do for business, right? You go buy them from CVS. When you come back, this is going to show up as drugstore on your itemized bill. What I'm trying to say is, seriously, the better you are at registering everything you bought, is just much better. About pens and papers, it's gonna go under something called supplies. And I'm sorry to be like very particular, but that's what accounting is. It's just being very particular about everything that's happening. Because if you input stuff right in the right QuickBooks, if you want to use it, or Excel sheet, or even on a pen and paper, where does it belong? Anybody can look at this and say, that's how much money they're making, right? I see here some folks do classes, wellness classes, belly. I don't think it's belly dancing. I think it's belly wellness. I just figured it out. So this person who has this business, right? For you to know how much does it cost you per person that comes in there to get him through the door, and how much money does he bring you, that will be very easy once you have all this inputted and divided. Yeah. Do you know what I'm trying to say? So it's very, very crucial to put the stuff the right way. Yeah. And that makes it easy for the tax accountant as well.
Good point, Danielle. There was a question in the chat about someone who invested their inheritance into the business, and where does that show up? So that shows up in owner's equity, and it's good to see that you have invested your own personal funds into the business, and that's certainly a positive. But that will show up in the shareholders' equity portion of the balance sheet.
Mm-hmm. Yeah, thank you. Great point.
So if I'm reading this correctly, let's just do this. reflect in the balance sheet. I do not believe my accountant wrote that off. I don't know what wrote that off means, right? So how did he write it to portray? Hopefully it shows up in there as he stated. If not, please remind him and say it to him again. Hey, buddy, where did you put that? Like, does it show? Show me where it is. You know what I'm saying?
So just to jump on, let me interrupt you a little bit there. No, but I think what you mean by writing off it was a tax deduction. So no, it's an investment. It would not be a tax deduction.
That's the, yeah. I just want to make sure.
Hopefully that answered the question.
So time-wise, we probably need to get into the cash flow statement.
Yep, I'm moving on. Thank you.
One question as well, he asked if he should use his line of credit towards paying employees. My dad taught me you pay your employees, whoever works for you, before their sweat dries. So absolutely, you got to pay your employees, right? But should you use that money for it? Yeah, like you should use it to pay your expenses per se, and then you have something to show for it. But I am hoping you are making more than you are spending. And basically, like David said, the first thing that should come out is paying your business debt, because that's a debt, that's like money that you have to pay your other debts with. So that goes for the top. So definitely make sure that is paid as well.
And that's a perfect question for the cash flow statement section. So we should jump into that.
I got you.
Yes, sir. Okay. So cash flow projection, very important report. It kind of sets you up to run your business, and give you an idea where you're going to be, where you're at, and it kind of projects things for you so you can kind of plan accordingly. Cash flow projection is a tool to help you manage your cash so that you can pay your bills on a timely basis and keep the doors of your business open. Now, why create a cash flow budget? Cash flow budget is not only concerned with the amount of the cash flow that you have, but the timing of those flows. Many cash flow budgets are calculated for different time periods. A well-constructed cash flow budget not only projects the cash balance remaining at the end of the year, but also cash balance each individual month. And that's where we so one of the things here at Baltimore Community Lending, one of the things that we do is I assist people with putting this projection together. We actually use a 24-month projections. You see the ups and downs. It kind of follows, I guess, a big reason or would help your business would be, say, if you're seasonal, say you have a lawn care service. So you want to make sure that you're able to pay your bills when business is slow. So when November and December comes around, you want to make sure that you are budgeted to carry your expenses. The other one would be receivables. For example, or account receivables, in your inventory, making sure that you can carry the purpose of that, or make sure that you budget for that as well. So again, making sure that you have those funds to make sure you can purchase what's coming due.
There was a question about personal funds. If you contribute personal funds to your business bank account, what should your accountant tax person do this with? He should list it as loan from owner. Definitely. And then we'll go from there. So talk to your accountant about it, because that's the contributing funds, and that's how it's supposed to go in the books of your business, meaning in your business.
Let me correct that. I'm sorry. That would be an investment, not a loan, an investment.
Somebody.
If you invest,
you can, without interest, sure. But if you want it back, definitely just make sure you put it in there, unless if that's your investment, it's got to stay in the business. Absolutely.
So just to make that clear, you can contribute funds to your business either as equity that stays in your business or as a loan to the business with or without interest. So you need to talk with your tax advisor about the best way to handle cash injection based upon your intentions for how money comes out, or whether or not he will need that money in the near future. So it could be either way, as equity, which the business doesn't pay you back directly, or as a loan on whatever term you and your accountant believe works best for you. Understanding that if it's a loan, when you come to a lender in order to look for additional financing for your business, we'll consider that debt payment schedule in the financial analysis as well.
Absolutely, absolutely.
Thank you. Just to kind of tie that up to another big reason for the report or cash flow, why it's important. If you're planning for an increase, for a large expansion, or you're looking to purchase, you need a new freezer, what have you, for your business. So it'll kind of help you prepare for that, to make those investments into your company. So managing that cash flow. Any other questions, comments?
I am just making sure we addressed every person who had spoke, but I think we have. If we didn't address you and we've missed you, please put it back here again.
All right. So I just wanted to discuss some of the impacts. Like I said, the number of decisions that can be made by your cash flows or to help you to manage that business, whether or not you need to increase the number of items you sell, increase your prices, reduce your expenses, change the timing of your expenses. You may have to obtain some sources of cash other than sales, such as a line of credit. I think someone mentioned already about using a credit card. So it can kind of work that way as well. Reduce the change, the timing of your owner's draw. You may have to adjust that to your to assist your business. I know some people, some businesses, especially if you're dealing with federal contracts, it's 3 to 6 months before you get paid. So you got to make sure that you have that cash flow and you can account for that. Research your vendor, so that turn time, your vendor, as far as when you're paying them, is it a 30-day turn, a 45-day turn? Also looking for lower prices, and then establish your policies to make sure that you get paid sooner from your clients if you have receivables. So if you have again 15-day, what is your turn time? 15 days, 30 days, 45 days. So all those things will be important to the impact of your cash flow. And I'll always have to include delinquency in there. So manage that 2 to 3% delinquency that you're going to incur.
Great points. I'd just like to add that, there's a big difference between cash flow and profitability. Mm-hmm. So your business may not be profitable, but through you injecting your personal funds, or you borrowing with a credit card, or you borrowing with a business loan or line of credit, there's enough cash available to cover current expenses. But even though there's enough cash, a lender, a bank or Baltimore Community Lending is looking at the operational profitability of the business. So it's going to look at the revenue coming in and the expenses going out to see if the business operationally is profitable, separate from the cash sitting in the bank account that came from a loan or came from your owner's equity injection. So don't get too carried away and think everything is great because there's a lot of money in the bank. The bottom line is this business operationally successful or operationally moving in the right direction or operationally projected to be profitable? So is it on a right trajectory to be operationally successful? That's important. That's where all your financials come in, the P&L, the balance sheet, and the cash flow statement.
Any questions?
Sorry about that, everyone. I had a little technical difficulty.
Any questions for a move? All right, so
Go ahead, David, I'm sorry.
yeah, go ahead. That's fine. So just to summarize this, as we say, we understand it's common to struggle with cash flow, to turn your sources really quickly, cash such as credit cards, online loans, which it's kind of a slippery slope. So you just want to make sure that you kind of stay on top of your reports again. Planning. Again, I think that's what we mentioned, that we start with the projections, making sure that we understand, what kind of ebb and flow we're going to have and prepare for those downtimes. So it's part of understanding your financials, making sure you review those reports quarterly. I'll say monthly, but monthly at least quarterly. I'm looking at that P&L and that balance sheet, making sure that things are in line. I strongly suggest benchmarking. And what I mean by benchmarking is that you're comparing to what is the average for your industry. If you're in the restaurant industry, what is the average? If you're in the transport industry, what is the average? So you want to know what the other companies are doing. Are you in line? And of course, your goal is to beat that. You want to be below the average. That discipline, if you put that, I'll tell a story. One of our clients, as one of Ulric's clients, difficult time with the reports. We reviewed. Ulric spent a lot of time with her. Reviewing those reports, teaching her how to understand those reports, teaching her how to read them and understand them. And it was like a whole new world opened up. Her comment was, Ulric, you want me to let you release that, or?
Well, there are quite a few of them, but just to address that generically,
yeah.
Our intention here today is to get you more conversant, more comfortable with what the three main reports are that you need to be familiar with and you need to use. And that way you can have more informed discussions with your accountant or bookkeeper, either in working with them going forward or in selecting a new one, right? So someone asked a question about recommending bookkeeping services. We have some that we've worked with in the past that provide a good service. However, there's also a situation recently where there was an accounting situation that I questioned, and in a conference call with the business owner there and the accountant was able and willing to address it, resolve the tax concerns, file amended tax returns, and we were able to move forward. So having an accountant who is not addressing all of your needs is partly a problem of the business owner, who needs to be able to have informed discussions with their accountant or bookkeeper and ask the right questions, because at the end of the day, it's your business. Yeah, you're paying the accountant, we get that, but you're ultimately responsible for the end result and growing it. So you should have a better handle on at least being able to say, hey, quarterly, I need an income statement, a balance sheet, and a profit and a cash flow statement. What will that cost me? And will that be a problem? And you're more empowered after this webinar to ask certain questions and to get responses that make sense to you, because you are employing the accountant. They don't take over your business because they know numbers and you know restauranteering or whatever. You're employing them to provide a service. So you have to be able to have a discussion with them to understand what they're going to provide, how they're going to provide it, when they're going to provide it, and how much it's going to cost. That's on you.
That is a great point. Additionally, ask yourselves a question. Why do you think a landlord or a bank or somebody you want to do big business with asks for those figures, right? Why? Let me I just want to know, I just really want like at least 3 folks, hopefully new folks as well, that's going to contribute to this chat. Why do you think folks ask for these? If you just put it in the chat, that would be really helpful. And I want to comment on that afterwards. Let me see what you all say.
Yeah. I see someone ask, what percentage of businesses do we approve?
Yes.
So that's an interesting loaded question. So for a business to be ready to go to our loan committee, they have to successfully complete the business coaching technical assistance program. So the real question is, what percentage of businesses are ready to complete our business coaching program? Because once they complete that, the majority of them go to loan committee and are successful in obtaining a loan. So the real challenge is for the business owner to commit to the coaching and to commit to any meaningful changes that need to be addressed or things that need to be learned prior to being ready to go to the loan committee.
Wonderful. I'm glad you answered that question. What I want to tell this person as well, hopefully you're in the percentage that we approve. So don't worry about percentages. Let's just make sure your business is taken care of. And that is big, right? Additionally, the 3 things that people have put in the chat are so important. I think everybody can see the chat, but let me tell you what they have been saying. They are saying to see how well or poorly your business is doing, to have a financial snapshot or to secure their interest. And yes, 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 yes. But think, if they do that, don't you think you should periodically do this? Look at this and see, what's going on with my business, right? And that's how you work on your business, not in your business. And what I mean by that is the following, right? If you want to go from point A to point B, if you want to go from Baltimore to New York, right? So you're going to put New York as a destination in your GPS. Aren't you going to check your GPS and see, am I going on the right track to go there? That's bottom line. That's why you look and you develop the discipline to review them periodically. And what I mean periodically is every week. You should know off the top of your head, if you are a hairdresser, the person that's coming to cut their hair, how much is it costing you to get them in there? And how much did they give you money to do it? And how much did you pay your fixed expense? That's supposed to be at the top of your head. And that introduces another concept, which is for another time. It's called the break even, right? David and I talk about this all the time. If people know that at the top of their heads, they can do great, because then the New York trip will be the destination at all times. They can, based on their money, based on that number, the break-even number, they just know they can now go to Alaska, not just New York.
These are good points. These are great points, Danielle. I see there's another question in the chat. If someone is asking for our website, which I'm sure our partners at Downtown Partnership will post towards the end of the webinar, and also a question about our fees. What fees do we charge? So there is no fee for the business coaching and all the services that we provide that prepare the entrepreneur for being successful. However, there is an application fee at the point that the business owner and the business is ready for a loan request. And currently that application fee is $100, and there is a credit report fee. So we pull a credit report on each of the owners or guarantors for the business that own at least 20% or more. And currently that fee is $40 for each credit report. There are no other fees to participate in the program. There are the usual closing cost fees, which vary based on the size of the loan, because we incur costs in recording various documents, which is not the primary topic of this webinar, but the fees that you're responsible upfront for would be the application fee after you complete the business coaching successfully, and the credit report fee for each guarantor of 20% or more after you complete the business coaching successfully.
I have questions. I don't know if I'm the only one seeing them because that came in the question and answers. How do we sign up for the business coaching program? How do I contact business coaching program? Please, our partners at Downtown Partnership of Baltimore will be putting a link, Jacqueline, as the first point of contact, and you will tell her, I would like to meet with Danielle, I would like to meet with David, and definitely that will be taken care of. And I'm looking forward to see you guys and to be able to help in any way we can. David and I are think the same way on this one. We are here for you.
All right. And good luck to you guys in your downtown partnership program.
Thank you all so much for helping us out today. David, Danielle, Ulric, on behalf of Downtown Partnership and all the attendees today, thank you for taking the time to go through this. It was incredibly helpful. So everyone knows I will be following up by email with all the worksheets and the presentation from today. I've already sent it in the chat, but I just want to send an email just to make sure that you guys have it. I've also put Jacqueline's email address in the chat here as well. So again, she's your first point of contact if you want to get in touch with BCL to talk to them about their loan offerings or anything else. So Jackie is the person to talk to. We have a couple more minutes, so I'm just going to leave it just for a little bit to see if anyone else has any questions just before we close. Just a couple more seconds just to give people a chance to put something.
I have a quick question. Did anyone today learn something that they did not know yesterday? Yes or no?
Great question.
I want to see, let me see how many participants we have. 31 minus 5. I want to see 20 some answers. If not, we can stay here until 7 p.m. I'm joking. That was your punishment, huh? Come on, let's see.
No, I will not be staying until 7 p.m.
Not already.
By herself.
I will do it. Until somebody gets something that they didn't know yesterday. Let me tell you, this is so crucial for you guys to know how to do your finances. This is the key to a lot of things. The resources, grants, loans, a lot of stuff. Know your business. I know you love your business. That's why you're doing it. But you got to know your business. And I know you work in your business. But do me a favor, 1 hour a week, work on your business, not in your business. Okay, 1 hour. That will make a big difference, you guys. And we are here for you. As I stated, it was such a pleasure.
Okay.
Yep.
Wonderful.
Oh,
All right.
Ulric, you have something in here that you guys need to see. What is this person saying? Hold up. Oh. Of course he does. So Miss Audrey is in here talking about good stuff about you, Ulric.
Yeah, Andre, good to hear from you. It's a pleasure working with you, and I expect to see you with the coming seasons coming up. I expect to see you out there. I'm sure I'm going to run into you selling your memorabilia. So great working with you, and look forward to continued success. Thanks for the shout out.
Love that.
Oh,
What a great testimonial.
I know. Unexpected. We did not pay her. I promise you that.
All right. Well, I think that's a good note to leave it on. Thank you all so much again. It's great to talk to you. And thank you all to our attendees for listening in today. I hope you have a great rest of your day and a great weekend.
Thank you so much.
Pleasure.
Bye-bye.
Bye.
Bye-bye.